One of the most common, it's following people on Twitter, following the herd. That is so dangerous.
Okay, so what would you say are other no-nos for investors? What are some of the more common mistakes that you see people making?
One of the most common, it's following people on Twitter, following the herd. That is so dangerous. Again, once you're seeing everyone pumping it on Twitter, you can almost guarantee that most of the money is in already. Sure, occasionally you'll make money. You're playing musical chairs at that point where you just hope you get out before everyone else gets out. But that is a recipe for disaster. What you need to do is you need to go to your drawing board. You need to find the plays that make sense based on technical factors. But again, that is a huge one. Another thing is, again, like we discussed, putting too much money into a trade. That's going to make you emotional because when it goes against you, you're going to make the wrong decision. The markets are shark-infested waters. They will test you. If you put too much money, they're going to push you to your extreme. You're going to get out of that position. And I almost would say most of the time it's going to go back in your direction. Your thesis might be right, but if you overinvest, it's going to shake you out before that move comes in.
Okay, so what about diversifying your portfolio? Because that's often a mistake that people make without sufficient diversification. What is your approach to general diversification of a portfolio?
Yeah, I think that
across asset classes and positions.
Yeah, I think that's a must do. You must do that. Again, this is part of a healthy portfolio. It's a part of risk assessment and risk diversification. So again, having a core position in gold or a core position in something else is always a good idea. Something that you think based on your technical thesis will have longevity and will consistently grind higher. May not make you a millionaire overnight. A core position shouldn't do that. Then you have your other positions sprinkled in. You can have your couple high risk positions as long as they're small. You have your other key positions out there, but absolutely you have to diversify. And by the way, that doesn't just go for stocks or with crypto or with anything else. You can diversify with real estate. You can diversify with gold. You can diversify stocks, oil. There's so many ways to diversify in this day and age, and crypto as we talked about, that again, really, that's the portfolio you want. Because what you'll find is that sometimes the positions that you think are going to do well don't do well, but then you might have invested in gold and maybe that's your big leader. You don't know. And that's the beauty of investing, is that it kind of picks your portfolio up when one side does well, but one side doesn't do so well.
And can you use technical analysis across these asset classes that you've mentioned? Can you use technical analysis when looking at the real estate market, for example?
You can, and that's what's so exciting about it, is when you learn the charts, you can chart anything, all right? As long as you have data points that you can put on. Bull flags are bull flags, whether they're in real estate, whether they're in stocks, whether they're in cryptocurrencies. When you get these euphoric blow-off tops like we saw in real estate in 2007, that was an indicator that, again, we were just about to come crashing down. Now we saw that in crypto last year in late 2021. We saw it in stocks in late 2021. These blow-off tops, crazy risk taking, it's all the same, because again, this is the beauty of it. It's all human emotion driving ups and downs. Buyers are buying for greed, sellers are selling for fear. That happens in all assets.
And you're convinced that human emotion doesn't waver, doesn't change since we've started tracking this? Are we just that predictable as humans?
Unfortunately or fortunately, we are. And that is the key, is you could go back 100,000 years, even before they were doing anything but trading whatever. And again, I encourage people to look up tulip mania, which had, the tulips, a tulip bulb, where a tulip was basically, you could get a house for it back then. It was one of the first major bubbles documented, and ultimately it came crashing down. People lost their houses, they lost their fortunes on this. It was exactly like so many bubbles since then, the dot-com bubble, and you could just go on and on. So this is the way humans are built. We are built as emotional people. Those of us that can get emotion out and get disciplined will excel and make endless amounts of money in the markets.